Let me ask you something uncomfortable. If rich people invest in the same stock market as everyone else, why do they keep getting richer while most people stay stuck? You were told the rules are simple. Save money, buy some stocks, wait long enough, and you'll be wealthy. But here's the mystery. Millions of hardworking investors follow that advice every year, and still never break free financially. Meanwhile, the wealthy seem to move through market crashes, recessions, and inflation like they're playing a completely different game. So what's really going on? Today, we're re-exposing how rich people actually invest their money, not the surface-level advice you hear on social media, but the deeper strategies that quietly compound wealth behind closed doors. And as this story unfolds, you'll see something shocking. This isn't just about money. It's about systems, access, timing, and behavior, and how small advantages repeated over decades create massive outcomes. But to understand the strategies of the wealthy, we first need to rewind time to where modern investing really began. Long before apps and online brokers existed, investing was never meant for everyday people. In the early 1900s, stock markets were dominated by industrialists, bankers, and elite families. Names like Rockefeller, Carnegie, Morgan, and Rothschild didn't just invest, they shaped markets themselves. Here's the first important pattern. Wealth didn't grow from salaries. It grew from ownership. While most people traded time for money, the wealthy focused on owning businesses, land, railroads, factories, and financial institutions. The system rewarded those who controlled assets, not those who worked inside them. Then came a major shift. After World War II, governments encouraged public participation in markets. Pensions, retirement accounts, and mutual funds opened investing to the middle class. On the surface, this looked like financial equality, but behind the scenes, the wealthy never stopped using more advanced strategies: private equity, real estate, syndicates, tax shelters, and leverage. So while everyday investors were told to buy and hold, rich investors were building multi-layered wealth machines that worked even when markets slowed down. And this is where the first strategy quietly appears. The average person thinks investing means hoping prices go up. Rich investors think differently. They prioritize cash-flowing assets, investments that generate money every month, whether markets rise or fall. Examples include rental real estate, dividend-paying businesses, private companies, royalties, infrastructure investments, commercial properties. Why does this matter? Because cash flow creates financial oxygen. It allows wealthy investors to reinvest profits, survive downturns, and buy more assets during crashes. Here's the cause and effect chain. Cash flow gives stability, gives reinvestment, gives compounding, gives exponential growth. Meanwhile, most people rely on salary and income. When inflation rises or layoffs happen, everything becomes fragile. The wealthy protect themselves by building income streams that don't depend on their time. But cash flow alone doesn't explain how fortunes multiply so quickly. That's where the next strategy comes in. You are taught that debt is dangerous, and uncontrolled consumer debt is. But wealthy investors use a different type of debt: productive leverage. Instead of borrowing to buy phones, cars, and gadgets, they borrow to acquire assets that pay for the loan themselves. Here's an example. A wealthy investor buys an apartment building using bank financing. Tenants pay rent. That rent covers the mortgage, maintenance, and expenses. Over time, the investor gains ownership of a valuable asset using mostly other people's money. Now watch what happens next. As the asset grows in value, the investor refinances it, pulls out equity tax efficiently, and reinvests into new properties or businesses without selling the original asset. This creates a powerful loop. Leverage gives asset growth, gives refinancing, gives reinvestment, gives portfolio expansion. This is one of the biggest reasons wealthy portfolios scale faster than average investors. But leverage alone doesn't protect wealth. Markets crash. Cycles repeat. Which brings us to the next layer of the strategy. Most people think diversification means buying different stocks. The wealthy think bigger. They diversify across stocks, bonds, real estate, private businesses, commodities, cash reserves, alternative investments. Why? Because markets move in cycles. When stocks fall, real estate might rise. When inflation spikes, commodities perform better. When interest rates rise, cash becomes powerful. This multi-asset approach creates shock absorption. During the 2008 financial crisis, many retail investors lost everything because their wealth existed in one place: stocks. Meanwhile, Wealthy portfolios were spread across multiple systems. Losses in one area were offset by gains or stability elsewhere. But diversification is only part of the equation. The real edge of the wealthy comes from something most people never learn about. Here's the uncomfortable truth. The biggest wealth gains often don't happen on public stock exchanges. They happen before companies go public. Wealthy investors gain access to startup funding rounds, private equity deals, venture capital investments, business acquisitions, real estate syndications. When companies like Amazon, Google, Facebook, and Tesla were private, early investors multiplied their money by hundreds or even thousands of %. By the time average investors buy shares, much of the explosive growth is already priced in. So the cause and effect looks like this. Early access gives higher risk tolerance, gives massive upside, gives wealth acceleration. This access advantage quietly separates the wealthy from everyone else. But even with smart investments, fortunes can disappear without protection. Which leads us to the breaking point. Every financial cycle eventually reaches a breaking point. The Great Depression, the dot-com crash, the 2008 housing crisis, the pandemic market crash. Each time, something interesting happens. Retail investors panic, they sell at the bottom, they lock in losses, they leave markets completely. Meanwhile, wealthy investors prepare for crashes in advance. They hold cash reserves. They rebalance portfolios. They buy undervalued assets while fear dominates headlines. Market crashes become shopping opportunities, not disasters. But here's where many wealthy investors failed in the past. Some became overconfident, some overleveraged, some ignored risk. Which brings us to the mistakes and the lessons learned. Not every rich investor wins forever. History is filled with collapsed empires. In 2008, hedge funds and banks used excessive leverage. They assumed housing prices could never fall nationally. When reality hit, trillions were wiped out. Alas, even smart money can fail when greed replaces discipline. That's why modern wealthy investors adjusted their approach. Lower risk exposure, better diversification, stress testing portfolios, stronger liquidity reserves. This evolution shaped today's wealth strategies, which we'll uncover next. We uncovered something most people never realize. Rich investors aren't just lucky. They follow systems that turn money into a machine. But now comes the most powerful part of the story, the hidden infrastructure behind wealth. Because here's the shocking truth. Two people can earn the same income, invest in similar assets, and still end up with radically different financial outcomes. One builds generational wealth. The other struggles for decades. The difference isn't effort. It's structure, strategy, and timing. So now let's continue the story and expose the final layers of how rich people invest their money. The parts that quietly multiply results while remaining invisible to the public. Most people focus on how much money they make. Wealthy investors focus on how much they keep. Taxes are one of the biggest wealth destroyers over time. Even a small difference compounds into massive gaps. Imagine this. Investor A earns a 10% return but loses 30% to taxes. Investor B earns an 8% return but shelters income legally. After 20 years, Investor B often ends up wealthier even with lower returns. How do the rich do this? They use structures such as tax-advantaged accounts, business deductions, depreciation on real estate, capital gains strategies, trusts and holding companies, jurisdiction-based planning. For example, real estate investors can deduct depreciation even when property values rise. Business owners write off operational expenses. Long-term investors benefit from lower capital gains rates. This creates a powerful effect. Tax efficiency gives higher reinvestment, capital gives faster compounding, gives accelerated wealth. Most people learn about investing before learning about taxes, which is backwards. Wealthy investors reverse the order. But tax efficiency alone doesn't protect against emotional mistakes. That's where the next strategy becomes critical. One of the biggest enemies of returns isn't the market, it's human emotion. Fear causes people to sell low. Greed causes people to buy at peaks. Impatience causes people to chase hype. Wealthy investors remove emotion from the process they use. Automatic contributions, rebalancing systems, scheduled investment plans, portfolio rules, professional oversight. Instead of guessing when to invest, they invest consistently. Instead of reacting to headlines, they follow long-term allocation strategies. This creates a powerful psychological advantage. Automation gives discipline, gives consistency, gives compound growth. And here's where compounding becomes the true engine of wealth. This is the most misunderstood principle of all. Most people try to get rich fast. The wealthy try to get rich inevitably. They understand that compounding works best with three things: time, consistency, patience. When money compounds at even modest rates, the curve looks flat at first. Years go by with little visible progress. Then suddenly, growth accelerates dramatically. This is where most people quit, right before the exponential phase begins. Wealthy investors stay invested for decades. They allow compound interest to do the heavy lifting. The formula is simple but brutal. Small advantages times long time horizon equals massive outcome. This is why families that build wealth once often maintain it for generations, because compounding never resets unless it's interrupted. But now comes the most important question. Does this strategy still work today? Every era believes it's different. Every generation thinks the old rules no longer apply. But financial history shows repeating patterns. In the past, railroads created millionaires. Industrialization built empires. Oil created energy tycoons. Technology created billionaires. Today, the same cycle is happening again. Modern wealth is being built through artificial intelligence, digital platforms, data ownership, infrastructure technology, renewable energy, financial automation. But here's the pattern that never changes. Early adopters build wealth first. Late participants fight for leftovers. And just like previous cycles, those who understand asset ownership, leverage, tax efficiency, diversification, and compounding will dominate the next wealth wave. Meanwhile, many people repeat the same mistakes, chasing hype, ignoring fundamentals, reacting emotionally, overtrading, underinvesting, which leads us to the final chapter. Knowledge alone doesn't create wealth, execution does. Most people will watch videos like this, feel motivated, and then return to old habits. They'll delay investing, they'll spend instead of saving, they'll avoid learning deeper financial skills. The wealthy don't wait for perfect conditions. They build systems and adjust along the way. Here's the uncomfortable truth. The gap between rich and poor isn't closing, it's widening. Inflation eats savings. Asset prices rise faster than wages. Those who own assets get richer, those who don't fall behind. This isn't conspiracy, it's math. And that's why understanding how rich people invest their money isn't about copying lifestyles. It's about copying structures and behaviors. The three core wealth rules. Let's bring everything together. Takeaway number 1. Wealth is built through ownership, not income. High salaries can help, but ownership of assets creates freedom. Focus on building portfolios, not just paychecks. Takeaway number 2. Systems beat talent. Automated investing, diversification, tax efficiency, and discipline outperform emotional decision-making. Takeaway number 3. Time is your greatest asset. The earlier you start, the more unfair compounding becomes in your favor. Here's the final question I want you to think about. 10 years from now, will you be someone who owns income-producing assets, or someone still trading time for money? Because the strategies you choose today quietly decide your financial future long before results become visible. If this video opened your eyes, here's your next step. Like this video so the algorithm pushes financial education to more people. Subscribe to the channel if you want weekly breakdowns of investing strategies, wealth psychology, and financial freedom systems. Comment below which strategy surprised you the most: cash flow, leverage, taxes, or compounding. And remember, the wealthy don't wait for opportunity. They position themselves so opportunity has no choice but to find them. See you in the next video.